Good morning, everyone. It is my honor and pleasure to introduce our keynote speaker and Wells Fargo colleague, Charlie Dougherty. Charlie Dougherty is a director and senior economist with Wells Fargo's Corporate and Investment Bank. Based in New York, he covers the U.S. economy with a focus on commercial real estate, housing, construction, and regional sectors of the economy. He regularly writes indicator reports, produces special commentary, and contributes to the company's weekly economic and financial commentary. His commentary on the U.S. economy has been featured in various regional and national media publications, including Bloomberg's News, Yahoo Finance, and the Washington Post. Charlie holds a Bachelor's of Arts and a Bachelor's of Science from the University of Pittsburgh and a Master's in Economics from the Temple University of Philadelphia. He is a member of the National Association of Business Economics, Philadelphia Council of Business Economics, and the Business Economics Club. Please give a warm San Diego welcome to Charlie Dougherty.
All right, how's everybody doing? Good, all right. Just get the clicker here. So a lot to talk about. First, how about another round of applause just for everybody here to get up as early as you did to talk about economics. Yeah. There's a lot happening. There's a lot happening in the state of California, San Diego. Some good, some bad. But in the U.S. economy, we are going through a period of volatility right now. Now, if you look across all of the data, things are still positive, right? The economy's expanding. We're in growth mode, but things are slowing down. So this chart I'm showing is just real GDP growth. It shows the overall level of activity and how it's growing. Now, I'm sure many of you have noticed over the past, a few years now, there's a big problem happening in the U.S. economy. A big problem called inflation. Inflation is having a big impact on just about every part, every area, every sector, every industry, every geography of the U.S. economy. Look at consumers. Higher prices means consumers are not happy. They're still spending, but they're not happy about it. It's impacting businesses. Higher input prices. Can't find labor, got to pay more for it. Can't find the materials I need, got to pay more for it. It's impacting monetary policy. How do we get rid of inflation? We raise interest rates. Interest rates going up means economic growth is gonna slow down. Now, the big question right now, though, is, okay, the economy is like moderating, but there is a chance that it could just moderate and we get a soft landing, meaning the economy stays positive, it's below trend, but still technically positive. Inflation comes down on its own. Inflation moderating lets the Fed cut rates. Unfortunately, the probability of us getting a soft landing is likely pretty small. And it's small because of the recent events that have been happening in the banking sector. Now, it's not zero, but it is small. I'll explain why in a few minutes. But if you look at this chart, what it shows is that we are forecasting a recession to happen later this year. So there's red bars that go into negative territory. That's an economic downturn. Inflation is impacting consumers, it's impacting businesses. Higher interest rates in response to higher inflation. We arguably haven't even seen the full effects of that yet. So last year, the Fed hiked by 500 basis points? The most aggressive monetary tightening since the early 1980s. Unfortunately, we haven't even seen the full impacts of that yet. Add in the banking sector volatility, right? Credit conditions are tightening. That means less investment in the economy. That means a higher likelihood that we do get a recession. Now, everybody hears the word recession and like the hairs in the back of their neck start to stand up. And I understand, because we just went through two of the most severe recessions that this economy has ever seen. In 2020, because of the pandemic, the economy fell about 10%, peak to trough, 10%. 08-09, Great Recession, the economy fell by 4%. So the type of recession we're actually forecasting here is something I would call a mild or a modest or maybe even an average recession. What we're thinking is the economy goes down by a little over 1%. You go back in history, what this looks like is what happened in the early 1990s. And actually, the more I think about it, the more this current period reminds me of that time. We had a global conflict, Iraq and Kuwait. Energy prices went up in response. Inflation was rising. The Fed was tightening monetary policy, increasing interest rates. We had problems in the real estate sector, right? We built a whole lot of office buildings throughout the 1980s. That led to some issues in the banking sector. Between 1985 and 1995, over 1,000 banks failed. We had the S&L, the savings and loans crisis. The Fed was hiking rates and banks were tightening credit. All of that together amounted to about a 1.5% decline in GDP. So we have some turbulence, we have some headwinds in front of us, but we have pretty good momentum headed into this thing. The number one reason why we're thinking that this is a mild or average recession is that if you were going to go into a downturn, you'd want to go into it from a relative position of strength. And if you look at all of the economic data, that is the position we are currently in. Consumers have money. Yes, inflation is a big problem, but there's been a stockpile of savings that have been accumulated throughout the past 3 years. They're not over-leveraged, right? The big problem with 08 and 09, there was a lot of debt. People had too much debt. That's not the case now. Corporations, businesses, yeah, things are tightening up now, but over the past few years, a lot of businesses have done really well. Expanded profit margins, even so. So you put all those together, consumer, business, the two biggest parts of the economy in terms of spending, really strong position. So if you're going to go into a downturn, you'd want to go into it from a position of strength, and it looks like that's where we are. Now there is this big headwind in front of us. It's that banks are tightening standards for lending. So credit is the lifeblood of the economy. Credit is the lifeblood of the economy, and banks are becoming more cautious. Lending is becoming a little bit more restrictive, and you can see that in this chart. And why I said earlier that the likelihood of a recession has gone up, it's essentially because of this chart right here. So this is a survey that the Federal Reserve does. They essentially ask banks, are you tightening lending standards, and which areas are you looking closely at to tighten up? So you can see broad-based increase over the past few months. Got a lot of macroeconomic uncertainty, inflation. We think we know where the Fed's going, but we're really not too sure. So banks across the board have tightened standards. And the thing I'd like to point out here is, if you can see it, there's some gray bars that indicate recessions and downturns. And you can see what happens when the share of banks that are tightening standards goes up. You would almost always get a softening in the economy, because credit's the lifeblood of the economy. Now, if you kind of squint, I know it's kind of hard to read. If you kind of squint, there's 3 lines there. So it's bank lending for commercial real estate, bank lending to consumers, and bank lending to businesses. The area that's tightened the most is commercial real estate. So it has been broad-based, but the magnitude of tightening has been concentrated in commercial real estate for good reason, right? There's some obvious strains going on with the office market. But overall, this is a big thing that's happening, and I think the events of early March, right? You had a few banks go under, unfortunately. Now I think the impact of that on the macroeconomy is that, yeah, the big problems look like they're in the regional, smaller banks, right, that may have been overexposed to commercial real estate where the problem is. But now as a result, banks are looking really hard at what type of lending they're doing across the board. Now I've heard some people say, oh, credit crunch this, credit crunch that, and I disagree with the categorization that this is a credit crunch, by the way. Credit crunch is a very specific thing when even the best borrowers can't get access to capital. What I think is happening is that just capital is becoming much more scarce. And when something becomes more scarce, it becomes more precious and more expensive. But this is going to have an impact on the overall trajectory of the economy, which it was already slowing down. So the Fed has been increasing interest rates for the better part of the past year. They went another 25 basis points in early May. The impact of that, while the overall economy is still positive, right? We're still in growth mode, but underneath the surface, there's signs of weakness. This is the leading economic index. This is building permits. Tells you something about builders' intentions to build. This is credit spreads, this is jobless claims. This is all forward-looking data. A lot of the data we look at is backward-looking. We know what happened in April. We want to know what's going to happen in June. This is forward-looking. The point here is that we've seen declines here for the past 11 months in this leading economic index. We've never had a recession where you didn't go back and find a similar trend decline in the leading economic index. A pretty strong warning sign, in my view, that there's some moderation in the economy happening. And you see it in the manufacturing sector. You see it in a bunch of different places. The manufacturing sector in particular, though, you can see by this red line. The red line, again, think leading indicators. So in the manufacturing sector, there's new orders. So we know what type of new orders are coming in for manufacturing. When that red line is below 50, where it's been for the past 2 years, that means more manufacturers are experiencing fewer orders. That's a contraction. But it's not every part of the economy that's gone down. And the reason I say a soft landing is still possible is because of that blue line. That blue line is new orders in the services industry, services, travel, tourism, medical care, all that stuff that we couldn't do during the pandemic and there's a whole lot of pent-up demand for. That's boosting the services economy right now. So it's above 50. More service firms are seeing more new orders come in. It's been very resilient to higher interest rates, and it's been resilient because we have a lot of pent-up demand in the economy. And yes, inflation is having an impact, but consumers, households, have a lot of savings. They have a lot of equity in their homes if they're lucky enough to own a home. It's driving services. Services is the bigger part of the economy. Manufacturing is very important, but services is bigger. But it's all about inflation, and there's been positive news on inflation. Energy costs have come down. Oil prices, which I'm showing here, right? Russia, Ukraine, unfortunately, there's sanctions that remove essentially about 10% of the world's oil and gas supplies coming out of the pandemic. Strong demand, lower supply, price goes up. Prices have come down. Still elevated, but they've come down. If you look at this chart, the price of oil has come down markedly. But this means lower energy costs. Energy costs going up was a big driver of inflation. This is positive. This is what you want to see, because inflation is having the biggest impact on the economy. It's impacted consumers, as I mentioned before. Consumer sentiment. It's picked up in recent months, but it's still really low. If I saw this chart without having any other knowledge of what was happening, I would say the economy's in a recession, consumer sentiment being as low as it currently is. This is inflation. You go out, you fill up your gas tank, you see the inflation. Even if you're not doing that, you see it on the red and green sign when you're driving around. That's how you measure inflation. Consumers don't like it, but they're still spending. They're still spending. Now, this chart doesn't need any explanation. Just kidding. That blue line, that is consumer spending adjusted for inflation. Consumer spending is positive. It's blue and it's positive. It's above zero. Now, how did we get that? Inflation has been rising at the fastest rate in 40 years, and consumers are saying, I'm not happy about that, but I'm still going to go out and spend money. But the thing is, that red line, now that red line is very interesting. It's negative, and it's been negative for the past 2 years. That's inflation-adjusted income growth. So what we have here is inflation rising faster than wages and income for the better part of the past 2 years. So consumer spending still positive, even with inflation outpacing income. Okay, look in the background. That's the saving rate. This is how it happened. This is what's been driving consumer spending, which is 70% of the U.S. economy. A lot of savings. Fiscal stimulus, direct checks, child tax credits, a lot of stuff, PPP loans, a lot of fiscal stimulus. Add on to that the natural accumulation of savings from the pandemic. Can't go out to eat, can't go on vacation, don't need to commute anymore. A lot of savings. That stockpile of savings has been what's been floating that blue line, consumer spending. And it's still there. If you think that we can get a soft landing, this is probably the best argument for it. Yeah, the stockpile of savings has come down, but it's still there. It's like $800 billion. And the other argument is, let me go back here, that red line, right, inflation outpacing income growth, has now flipped. It's flipped because inflation has come down while income growth has remained pretty strong. So now we have inflation that's still a problem, right? There's still a 5 on the inflation data. We need that to have a 2 on it. Still a 5, but now we have income growth outpacing inflation. So again, consumer spending, a big part of the economy. If we can achieve a soft landing, that's one of the ways that we can do it. But there are strains, of course, emerging here in the consumer side of things. I'm sure we've all seen the headlines, credit card spending reaching record levels, and that's certainly true. But if you account for the rise in income growth, remember, incomes have been going up, and this is what this chart does, it looks a little less concerning. Looks like it's just getting back to pre-pandemic levels. But the point here is that it has gone up. More people are using credit cards to finance their spending habits. To me, that says, okay, this pile of savings is not evenly distributed, right? Higher income households have more savings, lower and middle income households have less savings. So we get more credit card usage. Okay, housing market. Home values went through the roof. 2021, things cooled off last year, but home prices, didn't really decline all that much. If you own a home, you're sitting on a lot of equity. In economics, there's something called the wealth effect. When you feel wealthier because you have an asset where the price has gone up, you're more likely to go out and spend money on big ticket items. Cars, vacations, put a deck on the house. It's a big driver of consumer spending. If you're looking for a reason to believe, hey, maybe we do get a soft landing, this is another reason why. Another way we get a soft landing is that the labor market is a real area of strength right now. Some economists might argue it's too much of a strength. We all know about labor shortages. But if you look at the data, what it says is, look, the unemployment rate is 3.5%. We're forecasting a recession. That's the most likely scenario. What happens during a recession, unfortunately, is you get an increase in the unemployment rate. But it matters where you're starting and where you're ending, right? So right now, the unemployment rate is around 3.5%. Actually, in April, it was a tick lower. The lowest in over 50 years, by the way. And what we're expecting to happen is the unemployment rate to go up to around 5%, which nobody ever wants to see the unemployment rate go up. That's the wrong direction always. But if you're thinking about, okay, we have a labor market that's really tight. Businesses can't find workers. We need businesses to have workers to grow. So we need a little bit of a loosening in the labor market. Economists estimate this, and we think it's somewhere around 4. We don't really know. It's very theoretical. But arguably, the labor market is probably a little bit too tight. For the long-term health of the economy, we probably need this to change. We need more balance in the labor market. Unfortunately, it's very hard to do. And what we're forecasting here is the unemployment rate to go up. Again, we're not looking for a magnitude of an increase that looks like 2020 or 2008 and 2009, right? Mild recession, mild increase in the unemployment rate. But this is, unfortunately, the only way we think that, and importantly what the Fed thinks, of how we get inflation back down to 2%, which is where they need it to be. But again, this is a big challenge. Strong labor market is amazing, but it's inflationary. It's inflationary because the labor force just looks a whole lot different now than what it was before the pandemic. This is the labor force participation rate. Yes, it's ticked up over the past 4 months, but it's still lower than where it was in 2019. There's a lot of different things happening here. The biggest thing is that there's been an acceleration in retirements since the pandemic. We've known about the silver tsunami. We know that baby boomers were going to be retiring. We thought it was going to happen over the course of decades. The pandemic made it happen over the course of years. This is a lot of folks leaving the labor force most times earlier than they normally otherwise would. Now, the good news here is that beyond that, if you look at prime age working folks, 25 to 55, for example, it looks like we're back to where we were before the pandemic. So people are coming back into the labor force, but you're still missing this really important segment, right, of older folks who have retired. And it's inflationary. So this is the number of job openings. And again, I'll explain the inflation piece of this in a minute. But again, for the soft landing folks out there, this is another reason to say, okay, maybe there is still a chance. because the labor market is strong, but it's just out of balance. So this shows labor demand. This is just job openings. Look what happened right after COVID. Job openings went essentially to the moon. And they've come down a little bit over the past few months, but they're still highly elevated. So you can imagine a scenario where businesses, after going through one of the tightest labor markets in our history, say, I don't want to do that again. That's a big cost to my firm. I'm just not going to hire new folks. I'm not going to fire people. And that's a potential way where you do get a soft landing, where it's just businesses kind of say, okay, we're not in expansion mode anymore. We're not going to cut headcounts. We're just going to cool off with hiring. And that seems to be what's happening right now. Job openings are coming down. Demand for labor is softening. But this is what we need to happen, because the big impact here on the overall economy is tight labor market means wages go up. Wages going up is a problem for inflation for a number of different ways. This just shows the employment cost index. What happens when you have low supply of labor and high demand for labor? The price goes, come on, we're at a college. We go to the multi-purpose room. All right. The price goes up. The wages go up. That's what's happened. We got wages rising at about a 5% annual clip. Before COVID, it was like 2.5%, 3%. That's what 2% inflation would look like. 2% inflation with like 2.5%, 3% on wages. So we need wages to come back down to something lower than what they are right now. So how do you get that? You have to get more balance in the labor market. Okay, we got demand cooling. Supply is improving. That's more balance. Add into the fact that we probably get a recession or a downturn this year. That adds to more labor supply. We get more balance, wages come down. This is really important. This is really, really important, because this is what you're looking at is what most economists view as a big source of inflation right now. Could be wrong, but this is one aspect of what's happening with inflation, because higher labor costs go into just about everything. So when businesses see this chart and are experiencing 5% labor cost growth on a year-to-year basis, what are they doing? They're passing it down to their end market. And guess what? Consumers are accepting it. Why? Because they're seeing 5% increases in their wages. They say, okay. So you can get this vicious cycle that happens in the economy, and the Fed doesn't want that to happen. You don't want the spiral to happen because of inflation and wages. But it's important, because the one thing to remember here is that the service sector of the economy, which we talked about already, has been more resilient. Labor costs are more influential drivers of prices in the economy. So that's really important to understand. But overall inflation has been driven, it has a number of origins, right? So we had the pandemic, everything shut down. We flooded the economy with stimulus. Everybody had money. Can't go out to eat, can't go on vacation. You can buy TVs and laptops and exercise equipment. All of that money shifted from services to goods. Those goods are made abroad. Supply chains weren't designed to handle that magnitude of a volume increase. That's why we got supply chain dysfunction. That's why the price of goods went up. That's how inflation started. On top of that, you have the war in Ukraine. Oil prices go up. Now you have energy prices on top of good prices rising. That's the inflation that started things off. The good news is supply chains are functioning as normally as they have been over the past 3 or so years. Now people are spending less on goods, and more on services. Now we're tapping into the strategic petroleum reserve, so we have more supply. Energy prices coming down, good prices coming down. The problem is now the services sector. Now everybody's going out to eat, going on vacation, using that stockpile of savings and the equity in their homes to go out and spend on services. So what happens to services prices? We have a tight labor market still. Services prices going up. If you squint, those gray bars represent services prices, elevated. Maybe you can say they're starting to decelerate, to moderate, to cool down, but still a primary source of inflation. It is fantastic that we got the consumer price index to go from above 9% to about 5% where it is right now. But that was always going to be the easy part. The challenging part is going from 5 to 2. Because to do that, to achieve that goal, you have to deal and navigate around a number of structural shifts in the economy, namely in the labor market, which is tight because a lot of people retired. People have money. They're spending on services, revenge travel. Does that go away with a 5% Fed funds rate? Probably not. So this is sticky. Now, unfortunately, there's only one surefire way in the Federal Reserve's playbook to get rid of inflation, the likes of which we're seeing right now. Let me skip ahead here. Supply chains are looking good. That's what those slides meant. There's only one way the Fed knows how to get inflation down. It's through a slowdown in economic growth. A soft landing theoretically could do it, but a soft landing historically is very hard to achieve. Very hard. We've only done it like 1 or 2 times. The most likely situation is through a recession. That's what we're predicting. Not a severe recession, but a recession nevertheless. Okay, so you have supply chains that are improving. You have a labor market that's moving into better balance. More supply of labor, less demand. Wages look like they're starting to soften up and will probably continue to do so. That's how you get inflation back down to 2%. Add on top of a recession, that's how it happens. That's what we're predicting here. So this chart shows PCE deflator. That means personal consumption expenditure price index. This is the CPI's cousin. This is the chart that the Fed likes to see. It's what Jay Powell at the Fed looks at every morning when he wakes up. We have inflation. It's going to be a bumpy ride down. We took the elevator up. We're taking the stairs down in terms of inflation. So by end of next year, we're probably looking at inflation with a 2 handle on it. And that's exactly what we want to see. And this is important because, again, this is impacting interest rates, and interest rates impact everything in the economy. Consumers, businesses, real estate, the banking sector volatility, all tied back to higher interest rates. But we're probably at the peak right now in terms of the Fed funds target range. So the Fed hiked by 25 basis points a few weeks ago. We think that's probably it. Now, where we kind of stand in contrast to financial markets is we're not expecting a quick pivot. So if you turn on CNBC right now, they kind of show, okay, the Fed has gotten to the peak, and now they're turning down immediately and heading down the other side of the mountain. It's not true in our view. We think the experience of prior episodes of inflation is going to let the Fed, or encourage the Fed, to keep the Fed funds target range at its current level for the remainder of this year. So we've seen more hikes than we're going to see, but we're not going to start to see hikes until the start of 2024. And the reason we think this is, again, the Fed has a strong institutional memory and they have nightmares about what happened in the late 70s and early 80s. Who remembers Paul Volcker? Yeah. So Paul Volcker was the chairman of the Fed during that time. We had two periods of inflation back then. So we had the first one, we got inflation, the Fed responded, hiked rates. Inflation came down, interest rates came down. We had a recession. Unfortunately, inflation came roaring back, so interest rates had to go even higher, even quicker. We had another recession. So we essentially had two back-to-back recessions over the course of several years. Very difficult time period. It was all because the Fed pivoted too quickly. They started the medicine, but then once things got a little bit better, they threw the medicine in the garbage instead of taking the full course. They remember that period. They see what's happening with inflation right now. They're going to keep rates elevated until inflation is closer to 2%. Remember, we got the CPI data this week. Over the past few months, we're averaging something like 5% on core inflation. Still too high. Better than 9%, but still a long ways off from 2%. We're headed in the right direction. Goods prices coming down, energy prices kind of coming down, but services, a big problem here. So the Fed's going to keep rates elevated even if we get a negative number on GDP growth. They're going to sit back and say, well, hold on a second. The foundations of the economy seem to be pretty stable. The consumer has a lot of money. Businesses have done pretty well. It's a challenging transition. But we're going to let things play out, and hopefully inflation is more convincingly back to 2%. At that point, let me go back here. The other thing I want to point out, once the Fed starts to cut, they cut. So yeah, we think the Fed's going to be on hold, and the financial markets think they're going to start cutting, like later this year. But whenever they do start to ease monetary policy, cut interest rates, they are going to go pretty quickly. Just go back in history of the past few cycles. You get to the peak, and then whenever they decide to start cutting and heading down the other side of the mountain, they go. They go quickly. So in 2024, you're looking at a Fed funds rate, at the end of 2024, that is significantly lower than where it probably is going to be at the end of 2023. Debt ceiling, fiscal policy, this is another big thing that's kind of crept into the news, right? Another risk. So what happens is, okay, we hit the debt ceiling in January, and now we're using extraordinary measures to kind of pay the bills. And there's an X date for when that stops, right? When we can't utilize those extraordinary measures or incoming tax revenues to kind of... So it's a risk. I mean, I've seen this story so many times over the past decade. It's hard to kind of think it's a big risk, but it's certainly a risk. If you think about what happened in 2011, which was probably the closest time where this was a real threat, the thing that kind of is concerning is the political backdrop kind of looked similar to where it was today. You had a Democrat in the White House, Democrat-controlled Senate, Republican-controlled House of Representatives, thin margins. Things went down to the wire, got resolved, but things went down to the wire. This can have an impact on financial markets, consumer confidence. But I think the highest probability right now is we do see a resolution here. Things probably, it's going to get, the X date right now, Secretary Yellen came out a week or two ago, said, okay, the X date, when we run out of the funds, early June. That's probably on the early side of many people's expectations for the X date. I think it's going to go down to the wire. I think it gets resolved. But it's another, fiscal policy has sort of become this new small risk, but increasing risk. You've seen it in, if you look at interest rates probably kind of take all of these factors into consideration, right? So the Fed is still keeping monetary policy tight, but again, we're probably seeing the last of the hikes, assuming inflation comes down. We're going to have more certainty with regards to macro policy, I believe, over the next year or so. We're going to have more certainty with regards to the path of inflation. It's coming down. That's going to let interest rates start to come down. They've already started to. There's been a lot of volatility in markets for good reason. But once you got to move through that storm, I think you're looking at lower interest rates across the board, right? The Fed only controls the Fed funds rate. They have a lot of influence over other rates, but those considerations, those macro outlook, inflation expectations, fiscal policy can play a role, but we're looking at lower interest rates over the course of the next few years, gradually descending. So housing, and we talked a lot about what's been happening with regards to the impacts of higher interest rates. So there's real estate, and I'm going to end with making these points. Real estate has been arguably the most impacted by higher interest rates. Last year it was residential. This year it's commercial. Residential, though, looks like it's stabilizing. For all you soft landing folks, the housing market, which declined sharply last year, looks like maybe it's not in full-on growth mode, but it's steadied, it's stabilized. Mortgage rates are still elevated, but they're not rising at the same rate that they did last year. There's no supply in the resale market. We have a big cohort of incoming buyers, right? The number of 25 to 35-year-olds right now in the economy surpasses the peak of the baby boom in the late 80s. 25 to 35. Imagine that cohort coming down through the housing market over the next few years. Mortgage rates are high, but they're not rising anymore, and they are not as high as they were in the early 1980s. People are buying homes again. We're not going to see a big, robust recovery, right? We have a recession in our forecast. Rates are still going to be elevated. The affordability situation is really, I'm not going to call it a crisis, but it's a really challenging situation because supply is just so low. Over the past decade, we've seen 16 million new households. We've built 12 million new housing units. There's an undersupply of housing in the economy. It's especially acute in California, and it's especially acute in Southern California. We just haven't built enough housing. And unfortunately, that has caused prices to go up, worsening the affordability situation. So this is the average mortgage payment as a percent of income. I suspect it's probably a little bit higher here in California. But overall, nationally, people are having to vote the highest percentage of their income to a mortgage than since the 1980s. Affordability. Let me just skip ahead here. This is going to be my last slide. But commercial real estate is the area of strain currently. So we had residential last year. It's stabilizing. Commercial real estate, though, because of higher interest rates, cap rates have moved up, property values have come down a little bit, still generally above where they were before the pandemic, but the big uncertainty here is the office market. So look at that red line, that's the office vacancy rate. It's around 13% nationally. This is a big area of strain. What do we do with all these empty office buildings? Well, for one, I think this is actually, that vacancy rate probably continues to go up. This is not reflecting sublease space. It's not reflecting lower just office utilization, right? We're only in the office, most people, 3 days a week. So that's probably going to continue to go up. But I do think right now, we're probably going to be working in offices more than than many people think, right? So we're expecting a national economic downturn. If we get a downturn, the labor market loosens. If the labor market loosens, managers have less, the power balance shifts back from employees who have been resistant to going into the office, back to managers who are saying, look, it's a challenging situation. We're experiencing turbulence. We need you back in your seat. So that could change things. That could expedite the return to the office. Once that happens, now we know where office occupancy needs long-term are going to be. There's a lot of office space that we got to figure out what to do with, right? A lot of the demand for office right now, it's kind of bifurcated, right? The trophy, Class AA, the great part of town, newly constructed, LEED certified, environmentally friendly. That stuff's doing okay, actually. It's the outdated stuff that's the issue. But we'll find ways. I mean, there are a lot of creative actors in the U.S. economy. We've seen that time and time again. We're going to figure out what to do with that, and it's going to come quicker than many people assume. A decade ago, people were saying retail is dead. E-commerce has ended retail. And what happened? Okay, well, we stopped developing new retail. Yeah, there's still some problems with like some malls, but we figured out a new creative way for these town center properties. They're outdoor, diverse tenant base. Now they're doing really well. Probably one of the most successful asset classes right now in commercial real estate. E-commerce disrupted things. The market adjusted. It took a few years. But now supply and demand are more in balance, and you see the vacancy rate, that purple line for retail properties, trending lower, while everything else is trending higher. So don't count out the office market just yet. I hear a lot of doom and gloom headlines. Yeah, there's going to be some challenges, but that's what happens in markets. That's what happens in the economy. We live in a cyclical economy. It goes up, it goes down. You get boom, bust, bear, bull. That's what happens. But overall, the economy looks like we are going to hit a downturn this year. We have inflation, moving in the right direction, but still too hot. The Fed's going to keep interest rates elevated until inflation is closer to 2. We have consumers that are sitting on a lot of savings. Their homes are worth a whole lot more. Spending is still positive, slowing down. But there's a lot of pent-up demand for services. So all of the banking sector volatility that we've seen recently probably, increases the probability that we do see a downturn. It's not 100%. But overall, because of the strong underlying health of the economy, not a lot of debt, consumers, businesses remain in pretty strong shape, the recession is likely to be short and relatively shallow. By this time in 2024, we should be back in pretty strong growth mode. And I think California is going to be right alongside of it. So let me stop right there. Thank you very much. And we have another exciting speaker that's going to come up right now.